Good day, fellow investors. We'll look at three coal stocks, we'll look at the coal price situation now, the coal outlook, and yes, coal stocks look like a good risk and reward buy already through that cycle. On my research platform I have a tab for your ideas, and there was this comment by Dylan, but also by many more out there, to discuss the P ratios of 2 or even future possible P ratios of 1 as steel demand grows over time due to India, due to whatever, coking coal price spike, and also the doubling of warrior met production in the next few years. So I've decided to take a look, a deeper dive, as you will see. We'll discuss the stocks, and if you like these analyses, smash that like button. Let's start immediately with the coal price. And we have seen a terrible situation in the pandemic 2020, then we have seen a boom never seen in coal history, only to see that subdue to lower prices. However, now with inflation, perhaps this bottom is now the new bottom here, as it is 50% higher over 5 years, but I think 50% is the inflation we have witnessed over the last few years. This is thermal coal, there is also metallurgical coal for steel, and you can also see that the lows were here. Then we have seen booms, and now we are a little bit higher on those lows. However, currently, temporarily, the sentiment is negative. SP Global has revised down its met coal forecasts for both March and the full year this case, and Indian steel demand has been unable to lift prices for Aussie producers. Rains have been good, winters have been mild, so there was a lot of production, and that led to lower prices and oversupply, and that is now the situation that also led to lower stock prices. And if we look at the forecasts, they are trimming those forecasts from 233 to 213, and also the long-term forecast a little bit lower to 227. And if we look at, this is from Peabody, you see here that their prices are even much lower, because you have to keep in mind this is FOB at the other side of the world. Then you have to also ship it from the States, plus whatever comes there, shipping, and now we have also tariffs. So their prices are much lower, their realized prices. That's also something to keep in mind, and you can see here also that they're expected to achieve 70 to 75% of the premium hard coking coal price, and that is something that has to be taken into account. And here is the met coal dry bulk freight differential USA to Asia, and you can see that the differentials are pretty significant when it comes to a ton of coal. However, if we look at average prices, long-term pricing should be up as demand exceeds supply, because there is less supply going forward, and we'll discuss that. The average for Chinese, that includes shipping, was 300 per metric ton, and it might also be like that going forward. Now it's already a little bit lower, but we have to see the long-term situation of supply and demand. There has been now tariffs that should also impact, perhaps make it more difficult for US exporters, but you will never know with tariffs what will happen. US exports to China exploded the last few years, especially as China banned imports from Australia, but now those are coming back and US exports are going down, but it is a global market and we have to see how it goes. If we look a little bit at the current news, import controls, as there is coal oversupply temporarily, this is thermal coal, but prices are going down. However, when we look at prices, especially for met coal, then we see that usually those bottom around the 90th percentile of cost. So sometimes it was a little bit lower here, 2014, 2015 below, and that is usually in a deep crisis. Then we can see at the 75th percent of production costs if you look at the cost curve. Cost curve is essential when you invest in commodities, and you can see here that the 90th percentile is 240, 75 would be 215, and then you always have to put the costs, but in this cost curve, the shipping costs for US producers are already included in that. If I increase this, so we could see also a little bit lower prices, but I don't think nobody will ever go below that 75th percentile, at least not for a long time. Therefore, now that coal is trading here, it is a very, very interesting investment proposition. Now, also you can see here the relativities depending on the various mines, on the volatile matter, coke strength, and things like that. I haven't dug deeper into these technicalities, but I have understood that the coal price is in a negative trend. ESG, Europe, you will see later in the outlook, nobody wants to touch coal because it's coal, it's ugly. However, if we go for production costs, depending with transport, with everything, with tariffs, we see that coal prices are supported by the cost curve. And then if you invest into low cost, that usually means low risk because the higher producers will retreat first, and then you wait for the next boom, and that is your coal investment thesis. Now let's go to the first stock, Alpha Metallurgical Resources, and then we'll come back to the coal outlook. The stock was almost bankrupt in 2020s, the business, very low coal prices, I don't know if there was some debt, then coal prices increased, they paid down all the debts, they were flushed with cash, and here they went on to do huge buybacks and the stock went nothing but up. But since then, the stock is down 70% on those lower coal prices. And I made a video on this on November 15, 2023, and the stock price was somewhere here, and I said the stock should go up on the crazy buybacks they are doing. The stock went up 50% until coal prices reverted. They stopped doing buybacks, at least not in that amount, and here we are now. If we look at the news, the stock is crowded with sellers now. That's what happens with cyclicals. You need to know when to buy cyclical stocks. And if we look at the business now, just look at the situation there. If we look at the profits, they went from 176 million in the last quarter of the year to a loss of 2 million. So they are making zero now at current coal prices. And if we look at what they are doing, we continue to see lower levels of met coal demand, which is keeping prices subdued. They strive to take actions, limit production, things like that. But lower amounts of purchased coal than previously expected, and then severe weather, things like that in their operating plants will increase the costs a little bit. And you can see here that the cost of coal sales is there, so when you add the shipping and everything, you don't make much money at current coal prices. But they still have a lot of money, they have a lot of cash, total liquidity of 519 million. They say they could do buybacks somewhere, but they still have, what, 400 million on their buyback situation. At current cash situation, they will not do buybacks because when it comes to coal producers, you simply cannot go to a bank and ask for a loan. You cannot even insure your workers, your productions, because nobody wants to have to deal with coal because of ESG regulation, going green, etc. That is the current situation with coal. Investment funds cannot buy coal. Even for discussing this, there will be certainly comments, you should not do this, you should not. I'm just sharing here. I have my opinion on green, ESG and everything, but I'm here just discussing the risk and reward of investing because that's why you are here. We will not enter into what is green because that is not relevant here. We have to look the numbers and we are just investors here. Whether I will invest or not into coal, that's something I'll keep for my research platform members. So we'll see. You never know. I'm not saying anything. Nevertheless, let's look a little bit into the company, the guidance there. So they have their costs and they are selling something at an average price of 143. That's the committed one. Something will likely be lower at lower prices, as we have seen declining prices. So again, we have to estimate that when it comes to the company, they will likely not make much when it comes to the current situation. At least certainly not as much as they made over the last years. Because this still looks good, you see a very low P ratio, there is good profits, but if I look at the last quarter, you see net income is, with the current coal prices, is negative. If we look at the cash from operations, deduct the sustaining capital, it's 15 million, costs, interest, this, taxes, it's zero. So we have a company now making zero, and how are you going to value something that makes zero? And you can see also here that they have done a lot of repurchases and now they have stopped. And that's another reason why the stock is crashing. As I said in the video a year and a half ago, when they stop doing repurchases, the stock will crash like a rock of coal. And you can see here, they have done that huge repurchases authorization, and then they have spent 1.1 billion till now, okay? And they have bought, what is this, 30% of the company for 1 billion. If we look at the market cap now, 1.1 billion is 60% of the company. This is why I didn't like these buybacks. I told you can buy here, but you must be sure to sell at the right time. Now, it's all about waiting for the next coal boom, and that's something we'll discuss later in the coal outlook segment. There are better stocks than Alpha Metallurgical. Let's discuss more. I've looked a little bit at Core Natural Resources. The stock is also down, perhaps not as much, but also 50%. And I looked, they have now merger, they are now merging for synergies, very low cost production for both of the companies. So they have combined 1.8 billion of capital returns over the last boom for that company, and that is 50% of the market cap. As you have seen, AMR did 1.1 billion of the market cap. So looks okay. They also had very bad times, and I think it was David Einhorn that really nailed that one, so that is touche to him. However, they also authorize repurchases. I don't know whether they will make it, but given their low costs, they should make something, but that certainly doesn't look as profitable as it was in the past. You see, metallurgical cash cost is a little bit lower. So if I look at the numbers here, this is from just Console, they'll likely make, I don't know, 100 million. If the other company also makes 100 million, that's 200 million per year. So some positivity, some profitability, but we really need higher coal prices for an explosion. Now, the next company is a growth company, and that makes things even more interesting. Warrior Met Coal, market capitalization 2.5 billion, and they are really investing in the growth, and that's why perhaps also the stock isn't down, because if you look at the situation, what they have now is not that important, because they might even increase these by 75%. They have very little leverage. As I told you, coal companies cannot really get onto loans, but it is a low-cost producer. However, it will become an even more low-cost producer, and that's why they are increasing production. Expected demand from India up, China down a little bit, but a huge deficit into the market is what they are projecting. But commodity producers will always project deficits, don't worry about that. Still, they have made a lot of cash flows over time, but they have been all investing into the new project that should bring production much higher. They still need to invest about 300 million into the production, and that should increase production from 8 to 14 million metric tons or whatever it is. If I look at this huge increase in production, they expect to lower production costs. If we look at the net present value of the project at average metallurgical coal coking prices expected, the value there is 5.4 billion. Of course, you need to look into the details, and they expected 233 for high volatility coal average price. Okay, it is also a little bit lower now, so if that isn't met, then the net present value is much lower. And I dug a little bit into the 2021 presentation, and you can see here that prices for the project were estimated at 150, even 120, and there is still net present value. Of course, not as much as now, not 5 billion, but 1 billion. Here you can see if met coal prices go lower from the 220. But still, if we look at this cost curve, with the new production, it's unlikely that the prices will go that much lower, that it will not be profitable for them. Here is another more adjusted cash curve production, and you can see how prices are much higher, and when prices go down, these guys eliminate production, and then prices simply stabilize in a crisis somewhere here, in a normal downturn somewhere at 90%, 75% of the curve in a big crisis. And you can see here how prices are going down, the realized price is going down, and that is also impacting the company, but they still have a little bit of investing, and when that investing is done, their cash flows should explode on the upside. And they did pay a lot of dividends in 2017 when the prices rebounded, then they survived, and now not that much in dividends and buybacks because they have all been investing with their own cash into the future production. They have done well since the IPO in 2017, but when they spend the money, this last 350, the sustaining capex will be extremely low, and therefore the cash flow there, no debt, everything great, will be huge. And if prices are where they are now, so somewhere here, they will be making $500 million in free cash flow. That's crazy. $500 million in free cash flow, of course, if met coal prices go even lower, but that is unlikely given the inflation and Indian demand, then it will be a little bit lower, but still, I think on average they should be doing $500 million. $500 million on the current market cap is a 20% free cash flow yield. As 2027, 2028 and full production is reached, perhaps we have an upside in coal, this stock could be a 2 to 3x from that perspective. The risk is, of course, that we have lower prices, but that is somewhat unlikely given what's going on in the world. And let's discuss what's going on in the world. The coal outlook. If I look at the situation, if you look at companies, then there is underinvestment, and therefore there should be more booms in the future. Teck is also saying, now acquired by Glencore, that demand will remain robust. However, supply growth is constrained, and you will see something later on the chart. Despite all the efforts, demand for coal is growing. China has been the big coal eating beast, but now people expect that, especially from met coal, India will take its place. Projected crude steel production in India is expected to keep on growing. Global steel demand is expected to keep on growing, and therefore also as the developing countries and India keep on growing, even if China declines demand a little bit, the long-term demand seems stable and also growing over the next few years. As that grows, demand forecast is especially going higher for coal, but nobody is investing. And even if we discuss electricity, everyone is investing again into coal-fired capacity. That's the reality of the world we are living in, and even the International Energy Association is still projecting growth for long-term total coal consumption. But if you look at history, as GDP increases, there is more demand for steel, and these populations, that is 5 billion people, will still increase steel consumption over the long term. And now there are different arguments also against coal. If we look here at the steel making capacity under development, there is also the potential of electric arc furnaces. Then there is Zurich insurance to say no to Met Coal, no insurance. But if we look at the situation there, discussing this article, there is a database also that says that 160 companies are pursuing 252 met coal expansion projects, which could increase the world's current met coal production by 50%. This is something that producers will not tell you in their projections, but is something to keep in mind. Of course, this is just announced projects. With the current low prices, you can cut 75% of these projects, and then in the next few years you again have some situation. Then I've looked a little bit on Bloomberg Institute for Energy Economics and Analysis. They have a different view again. They are busting the myth that coal is essential to make steel. You can pause a little bit and read this, and it's actually correct. Steel made without coal, look at this, 70% is in the US, which is something very interesting. It's a special case, distinct from other coal. They're also discussing how scrap steel, some say it's not enough to create steel. Of course, if the world is growing, then it's unlikely that you can recycle to fuel growth. If there will be no growth, then you can recycle. So it is a little bit shaky, and also metallurgical coal exports have a bright future. Again, that is something to be seen. Australian is a little bit dwindling, but if we look again, export forecasts, this is just for Australia, is down. However, if I look at the World Energy Outlook, they are constantly increasing there. This was the past projection, and now higher coal demand projection. And despite the 4-year lows, a global supply squeeze might be coming because of the low prices, and investment in new production has dwindled in much of the world as shareholders and banks increasingly refuse to approve new spending on projects. However, no spending, global demand keeps beating forecasts. This was the forecast from 2020, 2021, 22, and look at this, we are here now. So demand is growing no matter what we think about it. The new projects is not enough, and China and India keep on doing what they are doing. However, most developing countries are not developing new mines. However, now we are here. I think we are close again to a bottom. This is thermal coal prices, but look at this. A lot of coal plants are retired, cancelled, some are still operational, but still planned and under construction. That is unfortunately the cheapest source for these countries, and this is again 5 billion people. Investing risk and reward, it looks like if we calculate those 90th percentile costs that we are close to a bottom. Of course, we can always go to 75 percentile costs, which would mean another 30–40% down, but that is something you have to expect when it comes to cyclicals, so you never know when the big downturn will come. However, even in that situation, the companies should make profit, especially companies like very low-cost producers, and therefore, if we are close to the bottom here, maybe just you need to wait a year, 2 years, 3 years for the next boom, and then you make your 2x for, let's say, downside 30–40%, but that's temporary. If you can repurchase a little bit here, it should be something very interesting. If you really want to nail the bottom, then you wait from 20% future cash flows on the market cap. That would be 2 billion market cap for what was it, Warrior, and that is something that you can play around, maybe small position, if it goes lower, higher position, but this is the risk and reward of coal. On my personal conclusion, I haven't yet decided what I will do, whether I will do it. Perhaps if it goes even lower, I will recheck it. So on ESG, I wish we would live in a cooler world. I see global warming all around me, and we try to do our best. We don't eat meat, for example, but I see the sea, that the winter temperature where I live usually went below 8 degrees. Now it doesn't go below 11. So that's 3 degrees higher than the average over the last 20 years. That's something we should deal with it. And I hope that there will be technology that will all help us globally. But for now, we have discussed the data. This is the data. This is the risk and reward. Hopefully the Chinese will invent cold fusion, cold fission, whatever, and we can all be more in an electrical world, but that is for now only hope. See how it fits you, and then I also see how it fits me. Thanks for watching. I hope you received a lot of valuable information, and I'll see you in the next video.